Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me tell you what we have in store for today's show. First up, we're going to be talking about some Trump administration proposals that are going to potentially significantly affect the 401k market as well as IRAs. And so that means it could affect a lot of people that are watching today's show. I want to take you through those proposed changes. In our second segment, we're going to be joined by none other than our financial planning pro, Matt Sweet, Certified Financial Planner and Enrolled Agent with Randall Financial Group and my business partner. Happy to have him here. We're going to be talking about whether or not it's time for you to do a portfolio checkup. I definitely think it's the season, not only because it's fall, but because of where we're at in the market. So that's going to be a great conversation. And in our third segment, we're going to talk about something that, quite honestly, I didn't even know existed until I read about it about a week ago, and that's interactive life insurance. And so my thought was, if I don't know about it, maybe there's a chance you don't know about it, and maybe we should talk about it together. So that's the plan for the third segment. And then finally, we do have a question on a particular type of stock market order. We don't talk about this stuff a lot on the Money Pros, but I've gotten a couple of questions on something called a stop-loss order. So I want to try to answer that here on the Money Pros. So that's everything that we have in store for us today. So let's jump right into it. And the first thing I want to talk about is some proposed changes that the Trump administration, presidential administration, is requesting be made to both the 401k market and to IRAs. And the two changes are not related to each other, but the executive order requesting the changes was made together, and we're going to talk about them together. And so let's put up a slide. We'll talk about them one by one. And the first one is request to review required minimum distributions. So what does that mean? Let's talk about what a required minimum distribution is. We've talked about this a lot on the Money Pros before. Many of you are probably aware, some of you maybe not, but account holders that have 401ks and traditional IRAs, rollover IRAs, not Roth IRAs, are required to take what's called minimum distributions from their IRA starting in the year that they turn 70 and a half. Now, that minimum distribution is an amount that's calculated, and you have to take out at least that much, meaning you can't just leave that money in your IRA or your 401k to grow indiscriminately. So, of course, that is a tax bill that you're going to get when you take money out of your IRA that the government is expecting. Now, those distributions are based on your life expectancy. So that minimum distribution calculation is done utilizing a table that the IRS provides, and that table dictates, based on your age and your account value, how much money needs to be drawn out of your IRA every single year. The administration, the Trump administration, wants those life expectancy tables updated. So here's the information. The last time the life expectancy tables were updated was 2002. So we're talking about 15, 16 years ago, the last time life expectancy tables from the IRS were updated. Since then, according to the information I received, life expectancy has increased about a year and a half. So what would be the effect of changing the tables? Well, if life expectancy was 77 years old back in 2002, and those are the tables that we're currently using, if we push it, the life expectancy by a year and a half to 78 and a half, that would mean the required minimum distributions would go down. That means you could take less money out of your IRA. Let's talk about the other change. We'll throw up the slide. And the other change is allowing small businesses to team up on 401ks. Now, this may not only be relevant to you if you own a small business, but could also be relevant to you if you work for a small business. Currently, the law only allows related businesses, like members of a trade association, to combine 401ks into what we call multi-employer plans. Retirement plans can, the problem is that retirement plans can be pretty costly to set up. They can also be time-consuming to administer. That can be a significant burden for small businesses. 37% of small businesses indicate that plans are too expensive to set up, and 22% say that their organizations don't have the resources. So, if the rules were changed to allow businesses to join multi-employer plans, those costs could conceivably be spread out over multiple employers, allow costs to come down, and allow more people to have access to 401ks. So two important proposals that are out there that you should keep on your radar screen. All right, up next we're going to be talking to Matt Sweet with Randall Financial Group. Is it time to do a portfolio checkup? Stay with us. Welcome back to the Money Pros. I'm joined now by my partner at Randall Financial Group and our financial planning Money Pro, Matt Sweet, CFP, enrolled agent. Any other letters we're adding on this year? What are we doing, Matt? So good conversation today because this is something I'm seeing more and more with my own clients. I know it's something you and I talk about. But the question of whether now is a good time for a portfolio checkup. And I think particularly in light of the fact, I was just saying to a client just last week, in fact, that we're essentially in a 10-year bull market run. And when things are good, people don't pay a lot of attention, is my experience. They usually pay a lot of attention when the wheels come off the wagon. So things have been good for a long time. So the question of whether or not it's time for a portfolio checkup. But let's talk about the first question. Why would somebody need a portfolio checkup?
Well, what tends to happen over time, and as you said, especially well into a bull market like this, the portfolios can get out of balance, especially over many years. So for instance, parts of the market grow much quicker than others, and that leads to an imbalance within a portfolio. So certain segments like small caps or growth could become significantly larger. And what that does is it puts you at risk when the markets do reverse.
Sure.
So if a correction comes along or a bear market, you're at significant risk because of that. Those parts of the portfolio have kind of overgrown.
And I think you used two excellent examples, small caps and particularly large cap growth. People may not be aware that not only has the stock market done well, but those particular segments of the stock market have done exceedingly well.
Yes.
So if they're not paying attention, that portion of their portfolio may be a lot larger than they ever intended it to be. Is that a fair statement?
And when you see one part of your portfolio growing, you don't think of this, oh, this is a bad thing. This is good.
Some people even have the tendency to want to put more money into it, so they might actually double down on the problem.
Yeah.
What are some warning signs or at least indicators that there could be problems in the portfolio? Like if you were to review a portfolio for somebody that wasn't a client, maybe this is the first time they've come into your office, what are some of the things that sort of set off the red lights and say this is probably something that needs to be addressed?
Yeah, well, particularly people who have concentrated positions in individual stocks. You see this with 401k plans where the person owns a large portion in the employer stock. Sometimes 100%, which is scary, but it does happen. Also, people have inherited assets. For instance, from a parent who worked at a company for a long time, let's say if you inherit Exxon or AT&T, people tend to hang on to those positions after they inherit them for many, many years. And it can be a significant part of their overall portfolio, more than is really prudent.
What about not only concentrated positions in stocks, but maybe you have not necessarily concentrated positions in stocks, but particular asset classes?
That's right. That's right. So you could easily fall into a situation where you think you're diversified, but you're not because you have an over concentration in a particular area, or you're just simply not diversified into other asset classes. For instance, if you are, say, overly allocated to large companies, large caps. While things are going up, that's fine. But when there's a correction, you might be overexposed.
We see this particularly, I think, in the large caps now. We've talked about this from time to time on the show, but we talk about the FANG stocks, which have really been the stocks driving market performance now. I'm borrowing that expression from another market commentator, Jim Cramer, who has a slightly higher profile than I do, but I still admire his work. But he coined the term, and it's an acronym, right, for Facebook, Amazon, Apple, Netflix, and Google.
Right.
And those stocks are driving market performance to a large extent. So people could conceivably have a very large portion of their portfolio wrapped up in the performance of a very small sector of the market, in this case technology.
Yeah, that's true. And if you think of somebody who bought Apple 10, 15 years ago, they're not unhappy.
Right.
They're very happy.
So it's tough to talk them out of it.
That's right.
Amazon, even worse situation. I mean, Apple becomes the first $1 trillion net worth company, and Amazon, not to be outdone, comes right behind them, but in a lot less time it took them to do it. What should people do in these situations if they're heeding our advice and they say, right, I'm going to take a look and say, wow, I had no idea large cap had become such a big component of my portfolio. How do they handle that situation?
Well, it helps to start with, if you have a plan to begin with an asset allocation, that really helps because then you know how far off I've gotten.
Right. How do you know what's too much if you don't know what the target was in the first place?
That's right. That's right. So that's the kind of the first step, and then you look at the old rule of thumb was that if you have more than 5% in an individual stock, that's too much. And I think in this day and age of kind of hyper diversification, even that's way too much. I think more like 1%. But that would be a warning sign. If you have more than 5% in one stock, that would be a significant warning sign. And the just trying to think of the other.
Well, one of the things we talked about was tax consequences, right? I think one of the, and I find myself doing this when, it's one thing if you have an IRA and you realize, all right, I'm a little overweighted in large cap growth and I want to reallocate back to large cap value or bonds or whatever the situation is. But what if that money is in a taxable account and you're faced with the dilemma between, all right, I've got too much in large cap growth, I'd like to shift to another asset class, but large cap growth has done so well that I'm going to realize significant capital gains if I sell. How do I balance those two things? Because I'll tell you, that's something that I wrestle with when I manage client portfolios.
Well, if you work at this over time, I think it works a little better because over time you're only selling off a small portion of it. So you don't recognize as much gain, at least in the short term.
Sure.
So I think it's also important to kind of bite the billet on this. I mean, the capital gain tax rates aren't that high, and for some people, it might even be a tax-free sale if you're in a lower tax bracket.
I think of it a little bit like, and I totally agree with the analysis, but I think of it a little bit like, pruning the hedges. If you have a hedge in front of your house and you trim it every few weeks, nobody notices and it looks good all the time. If you let it grow wild, it looks terrible. But then when you cut it back, it still looks terrible, right? So the little bits over time mantra, I think, is probably important here. One of the questions I wanted to get into a little bit is with respect to mutual funds, because mutual funds are a fantastic tool for diversification because with a little bit of money, you can spread your money around to a lot of things. But does owning a mutual fund necessarily mean you're diversified? And does owning a couple or 3 or 4 mutual funds necessarily mean you're diversified? Well,
usually you would be diversified in at least one way, where you're not too concentrated in individual securities. However, you could still be far too concentrated in particular asset classes. For instance, too much in small cap or large companies. And not even be aware of it. Sometimes it's hard to tell based on the name of a mutual fund what its underlying assets are. And you could have several funds that are basically invested in the same things and not even realize it. They all hold Google and Facebook, et cetera.
Right, so you run into a situation where we have, we call it in the biz, stock overlap, right? So you think you have multiple funds that all have presumably good track records, low expenses, but it turns out they all own the same thing. And that's very common if you're not paying attention to what type of fund it is. And you can't always rely on the mutual fund to tell you, in their name what it is. You've got to be able to do your own research. They're also notoriously bad for telling you what they own, right? Unless you own an index fund where the index is pretty clearly prescribed. They're not real good at keeping us updated. Semi-annual reports are about the most you can get, generally speaking. But dig into that idea of not just the stock overlap, but the idea that with a mutual fund, you're diversified from a security standpoint, but you're not necessarily diversified from an asset class standpoint.
Right. So most mutual funds specialize in a particular asset class. At least that's their official strategy. But for instance, you might be significantly underweighted in bonds, or have no allocation to bonds at all in your typical mutual fund. You would have to have a separate fund, particularly that addresses that part of the market.
And it's fair to say, though, you can also buy a balanced fund or an asset allocation fund where not only is the fund company making the decisions for you about what individual securities, but then more broadly based on what individual classes. Another example is international. Where does international fit into this whole thing when we're looking at doing this portfolio checkup?
Traditionally, international has been a great diversifier in portfolios And people have had very good success with it. So it is an important aspect of your overall strategy. One of the things I find, though, is that sometimes you can be over-allocated, not just under. And one way this happens is that many funds have allocations to international that you may not even be aware of. So if your large cap fund has 25% of its assets in international stocks, your international fund is kind of duplicating that, and you may not even be aware of it.
So let's wrap this up. We've talked about a lot of different things with respect to asset allocation, diversification, setting targets. With about 20 seconds left, what are some tools that might be available to clients? We've got lots of them, but what can clients do to figure some of this out?
Well, even today, I still use Yahoo Finance. When I want to get a quick answer on things, you can actually plug in your portfolio. If you sign in, you can put in what assets you have, and it can give you some reports. Another is Morningstar. Same deal. They have
Portfolio X-ray we've talked about.
The X-ray is excellent, and it basically gives you an inside view of what's in your portfolio that it's hard to get otherwise.
So now's the time to look at the portfolio, folks, not when stuff is plummeting, and it's going to happen at some point. I'm not predicting it, the when, just the if. So now's the time to do a portfolio checkup. Matt, thanks as always. Great conversation.
Thank you.
All right, next up, interactive life insurance. What is it, and how is it going to impact you? Stay with us. Welcome back to the Money Pros. Reading an interesting article last week about something I really had not heard of before. But the headline of the article was with respect to John Hancock Life Insurance, which is one of the oldest and largest life insurance companies in the United States. I believe they're owned by MassMutual. And in 2015, they began selling something called interactive life insurance. And this most recent article was talking about the fact that moving forward, this is the only type of life insurance they were going to sell. Now, John Hancock's a big company, so if this is the only thing they're doing, I'm thinking to myself, why didn't I know exactly what this was? So let's talk about interactive life insurance. We'll throw up a slide here really quickly. First of all, first thing that caught me by surprise is it's pretty well established outside of the United States. In fact, interactive life insurance is heavily sold in South Africa, Great Britain, and a number of other countries, but it's becoming much more popular in the United States. Let's put up the slide again. We'll talk about the second aspect of it, which is basically what you receive is potentially premium discounts with fitness trackers. Now, this is the thing that I find the most amazing about the progression of technology and how it's impacting every aspect of our lives, including my life and the industry that I'm in. And here's the deal. You can receive discounts on the cost of your insurance if you agree to wear something like a Fitbit or an Apple Watch or a Samsung Watch, something that can track things like hitting exercise targets and a variety of other things that these fitness trackers do. So the more healthy lifestyle you lead, the less your life insurance could be. The other thing that interactive life insurance allows you to do, and we'll put the slide up really quickly, is web-based apps to earn gift cards and perks. Now, so if you don't want to wear a fitness tracker, and I would point out that it's optional, then you can also have an app on your computer or log into a website, and you can report things like healthy eating choices, exercise activity that you performed, things like that. So what I find interesting about this is, even though companies like John Hancock are only selling this type of insurance, the participation is not mandatory. So your experience buying life insurance could be the same. You sign up, you fill out an application, height, weight, health history, all of those things, and they determine a premium. But your participation means that you could actually receive discounts. So if you wear these fitness trackers, you get discounts on your premium. If you log into a website, maybe you get gift cards and other things as essentially a form of rebate. So it's not unlike auto insurers where you can voluntarily put a little chip in your car to report how fast you're driving and how quickly you brake and leave from stoplights and stuff like this. So this concept is moving on to the life insurance industry. But of course, the concerns are the same as they are in many aspects of our web-based life. Things about privacy, health information, where this data is going, but it never ceases to amaze me how technology and a small device we carry in our pockets now is reshaping the way we live and, in fact, the way we invest and pay for life insurance. All right, up next, answering a question on what a stop-loss order is, so stay with us. There's more to come. Welcome back to the Money Pros. Interesting question I've received a number of times recently, and I think it's because of what we were talking about earlier, the height of the market and the fact that portfolios are doing so well and people are just waiting for the next shoe to drop. When is this going to come to an end, which I don't have an answer to. I know it's going to happen, but I don't know when it's going to happen. So this is the question. Let me throw the slide up here, but it's really a summary of what a lot of people are asking. What is a stop loss order, and should I be using one to protect me in case the market drops? So this question comes up whenever, in my experience, I've been in a situation where the market has gone on a sustained run. People have heard this term stop loss order and they think it's some kind of insurance against a loss in their portfolio. And the name doesn't do it any favors because the idea that it's going to stop a loss is really a misnomer. Here's what happens. You have securities in your portfolio, mutual funds, exchange traded funds, stocks, bonds. You can put in an order with your broker and call it a stop loss, and you would give them a floor price. So if your stock or mutual fund is at $100 per share, you can say, all right, if it drops to $80 per share, I want that to trigger a sell order. And the brokerage will keep that order on file, but they will only execute it if the price drops to that point. So a fair point to be made about a stop loss order is it's not going to stop the loss. It's only going to sell you out at the loss, okay? So then you're faced with the decision about when do I get back in? And that is a really challenging thing to think about. Another challenge with stop losses is you want to make sure you continually update them. As the market moves up, you want to move your losses up. And the final caution about stop losses is the brokerage firm will not guarantee execution at that price. In a rapidly declining market, your execution could happen at a price, in some cases, substantially below the price that you put your stop loss in if they can't keep pace with the market. So that's a little education on stop losses. Generally, I discourage you using them. All right, that's it for the Money Pros. That's all the time I have. I hope you have a great weekend. We'll see you again right here next Sunday on the Money Pros. Take care, folks.